Hey there, welcome to the Covering Crypto live stream. I'm Jim Armstrong with Fidelity. Thanks for taking time out of your day to be with us. Well, for better or for worse, price volatility is pretty much inextricably linked with cryptocurrencies. Even if you're relatively new to the space, you probably already figured out that crypto is subject to wild price swings in both directions, right? So today we're going to spend the full live stream talking about exactly why that is, trying to understand what's behind crypto's price changes, not just in general terms, but also specifically, like what's happening in the world and in the US right now, and how those macroeconomic factors may or may not play a role in crypto's price changes. To answer your questions, we have a pair of absolutely fantastic guests who I'm thrilled to have on the live stream with us today. They're going to answer questions from two different perspectives, which is super valuable as well. So Denise, Martha, thank you for taking time out of your day to be with us. If you could just both introduce yourselves to the audience real quickly, talk a little bit about the perspective you bring to today's show, that would be perfect. And Denise, we'll start with you if that's okay.
Yeah, it's great to be back. So I'm Denise Chisholm. My title is Director of Quantitative Market Strategy, but I sit in equity research at Fidelity. I do it a little differently, though. I'm looking at historical patterns in data that I think can make us better investors over time. So if there's any market history question as it relates to the small history we've seen in Bitcoin or the large history we've seen in the S&P 500, I'll definitely take those questions.
I've got my eyes on the live chat, Denise, and they're already coming in. So be prepped for that. Martha, this is your first live stream. Thanks for joining the fun.
Thank you so much. I'm delighted to be here, folks. As Jim said, I'm Martha Miller, and I lead public policy and regulatory strategy for Fidelity. And my team's job is to ensure that we can delight our customers for years to come under a really strong rule book.
Love it. Excellent. Kelly Allen is with us as well today. She works on the broader crypto education team, and today she's going to be helping us navigate the interactive elements of the live stream. Hey, Kelly.
Hey, Jim. Hey, everyone. Happy to be here. Thanks for having me on today.
And we are going to start with a bunch of questions that came into us from registration. When you signed up to watch the live stream, many of you sent in questions. So we're going to start by answering a bunch of those. And we're going to start with the elephant in the room, I suppose. What's behind all the price drops that really came to define the cryptocurrency space in Q4 of last year and going on to Q1 of this year? So Joseph wants to know what's driving the recent price drop. Rajesh is asking specifically about Bitcoin and ETH. So Denise, start us off. What's going on?
Yeah, markets don't move in a straight line. I think we have the most experience with the equity market from that perspective. So I like to think about it as there's normal volatility and then there's abnormal volatility. And how do you tell the difference? So some quick numbers in terms of the S&P 500, 5% corrections are very, very normal in the S&P 500. They happen about 3 times a year. 10% corrections are normal still, meaning they happen usually once a year on average. But the equity market tends to advance 75% of the time. So that's a little bit of the math around the buy the dip of the S&P 500. But Bitcoin, specifically, I'll talk about Bitcoin because I have the numbers at my fingertips, is 10 times more volatile than the equity market. So to think about the drawdown that we're in the midst of 30%, is that normal or abnormal volatility? When you think about this, markets don't move in a straight line. And we've seen 6 such corrections, 30% plus corrections, in Bitcoin over the last 5 years, and yet it's up 300%. So when I look at the statistics, much like the S&P 500, you say, okay, 5% doesn't mean much, 10% is fairly normal. 30% corrections in Bitcoin actually are normal volatility in terms of what we've seen.
I love the historic context and the perspective there, but I also feel like, Denise, some people watching might find that really unsatisfying, and they wanted you to say, here's the 2 things, the 3 things that happened, and I want to be able to say with certainty what's going to happen again in the future, but that's not possible.
Oh, well, there's always like when you look back at a correction, whether it's the market or whether it's Bitcoin, we can all point back to a reason. The question is, was that reason actually predictive? You see oftentimes in the market where the market itself is a discounting mechanism, and Bitcoin overall might be a discounting mechanism of a phenomenon we call buy the rumor, sell the news. Yeah. So it might be that whatever good news that you thought was going to happen to Bitcoin this year, let's insert Fed rate cuts, lower inflation, maybe, perhaps that's one of the critical drivers when you look historically. Maybe that was at the peak potentially priced in at that time. So the recession or the receding of the price of 30% correction might just be that normal seesaw of buy the rumor, sell the news, meaning that yes, there might have been a catalyst, but at the same time, it's important to recognize that catalysts happen all the time for normal volatility. The part that we need to struggle with was as investors is, do you want to sell into normal volatility? More likely than not, the answer is no, because it's just normal.
And one of those potential catalysts, Martha, we'll turn to you to dive a bit deeper on, is the regulatory space. Certainly the past year to all of 2025 was marked by a lot more attention being paid by lawmakers, I would say, at the federal and at the individual state levels when it comes to cryptocurrency. So, whether and to what extent do regulatory changes and the potential for them move prices?
Yeah. It's a great question. And I think there's some mythology there. We actually did some math on it. We'll show you a chart in just a second, but I think it's important to clarify from the outset that regulation moves prices mostly by changing the distribution of future outcomes. So I like to think of it across three different buckets: who can participate in the market, what activities are permitted, and then with what confidence in the downside tails. And whenever there's confusion over what rules apply and to whom, it changes the risk premium. Instead of compliant intermediaries who are willing to touch an asset, crypto or not. So as we look at this chart that we pulled together, we did a little math here to see if we could spot whether some of what I'd call the biggest announcements in the policy and regulatory landscape actually made for interesting price spikes or dips. And if you look at it, you don't see major swings coinciding with announcements, but what you do see is a longer tail that follow those changes. And my hypothesis there is that the changes to the laws require implementation. They require you to get compliant with those changes, and that's not an on switch or an off switch. So much more complex as we look at the implications of regulation there, but certainly something we can dive into further today.
Yeah, I love that context as well. So it's not the headline necessarily that's going to move price, but it might happen incidentally much later on. Denise, I wanted to ask you to dive a little bit deeper on something you said a moment ago when you identified cryptocurrencies as an emerging asset class. I think that, right, as it's going through this price discovery phase, you're going to see price volatility. But I'm curious if you can point to any analogs or look back in history when there were other new emerging asset classes going through the same price discovery phase. Anything we can learn as people interested in crypto from other things?
Yeah, I mean, let's talk about emerging technology, and then let's also talk about liquidity later. I mean, I compare Bitcoin a lot to equities because it is the closest cousin to equities. If you look at the 6-month returns over the last, 20 years, really, in Bitcoin since 2010 or 15 years, you'll find the closest correlation is not to interest rates. It is not to gold. It is not to bonds. It is, in fact, to equities, and specifically technology equities. So I think the comparison of something like Netflix, that during the IPO days of 2000 was highly volatile. And what we saw, I think, during the sort of tech bubble, we saw a 41% drop in Netflix in one day. That was during the time when Netflix, it was not clear whether or not that was actually going to be a viable technology, whether or not that was going to be widely adopted. So you tend to see a lot of volatility when you don't know the adoption rate, when you don't know how mature the new technology is going to get. Fast forward to today, 20 years later, just on a math perspective, Netflix, same stock, has about a third of the volatility as it did when it was in that emerging class. Now it's essentially synonymous with television. But you can see as go adoption, so goes the decline in volatility. So that's one example of an emerging technology that volatility declines as adoption progresses. Another example is something we've sort of been experienced with as investors over the last 20 years as well, which is ETFs. So ETFs were just a basket of stocks. But when they were launched, they had low market cap, low adoption rates. They were a nascent emerging asset class. And because of that, liquidity was very important. So when it was an emerging asset class, those baskets, sometimes they were meant to reflect the underlying stocks in the basket. But during acute times of market stress, there weren't a lot of times, and it was usually very temporary, there was a big disconnect between the underlying stocks, the pricing of that, and the pricing of the overall ETF. I think back in 2014, we saw as much of I remember during the open, as much of a 7% disconnect. It got, reconciled during the day, but you could see that disconnect because liquidity was relatively low. Fast forward to today, 10 years later, a lot more liquidity, a lot more adoption, and now you don't see those overall disconnects. So I think that you see over time, and in some ways, this is why Martha and I are on together, because in some ways the adoption is very correlated to the regulatory forum. The more we have the rules of the road in place, the more likely Bitcoin and crypto and all other assets within it are to be adopted, and the more likely we are to see volatility decline.
Oh,
Absolutely.
thank you. Sorry, yeah, I love that answer. And Martha, I was going to say it tees up what I wanted to ask you about next, which is stable coins. The live stream's been on the air. I think this is our 4th year, and interest in stable coins, as measured by questions that come into us, kind of ebbs and flows. But right now, it feels like it's at a high point. A lot of people are curious about stable coins, and despite the fact that they are built to be stable, changes in the regulatory landscape that have to do with stable coins have ripples and echoes that have the potential to move prices for non-stable coins. So how does that work?
Absolutely. So we were really proud to support the Genius Act, which brought payment stablecoins into the U.S. regulatory perimeter. The landmark bill moved us from a market that was, to the extent stablecoins were issued by U.S. companies, they were subject to a patchwork of state oversight and ad hoc examinations. And now we have got the beginnings of a clear and durable national framework, which is massive for the industry. The law that was passed this summer clarified who can issue payment stablecoins, which high quality liquid reserves are allowed, and they set some limitations on the types of reserves that you can put behind those assets, and then how licensing and ongoing oversight will function. And I think the Genius Act is a fantastic example of how clear and durable rules can channel innovation into our financial ecosystem instead of around it. Now, as we watch over the course of this year, we're going to see a lot of implementing regulations coming out of the different agencies. Think Treasury, FDIC, OCC, that are going to be giving more specifics for how you go about entering the market, largely targeted at the institutional side of things, not at the what I call individual customer side of things. My expectation over the course of the year is that stablecoins are going to become far less exciting as an asset in of themselves, because the real excitement is going to be building around the solutions that you build on top of them, where stablecoins are the settlement layer. And that's particularly true. Denise was just talking about adoption. One of the key pieces of adoption is clarity for institutions, particularly heavily regulated institutions like financial services, how you go about engaging with a new technology and fitting it within your existing compliance and risk frameworks. So I fully expect that we're going to see this credible foundational layer, reducing a lot of the tail risk volatility across the ecosystem as institutions are able to bring it inside of an existing system and really build interesting and new tools off of something that really keeps that dollar peg in a safe way, and that they have a whole lot more predictability on what the regulators are going to be asking and how those assets are going to function.
And thank you for drawing that really clear line there that helps explain why a piece of legislation might not directly move prices, but it maybe impacts adoption, which then changes prices potentially in the long term. But while I have you, I want to ask about some other legislation that questions came in from viewers about the Clarity Act. Jesse wants to know how the Clarity Act might actually affect prices going forward. And then Christopher is really just making sure we're all on the same page. Appreciate you, Christopher. Well, what exactly is the Clarity Act and what does it mean to us?
Yes. So Jesse and Christopher, these are probably the most timely questions that we could get, because these bills are being actively negotiated as we speak. And sometimes people say as we speak, and they just mean it hypothetically. I mean, literally active negotiations. Then they're headed for a markup of one of the bills on Thursday. So 2 days and counting, and lots happening behind the scenes. I'll take a step back. Clarity Act, which is one of those all caps acronyms that stands for lots of different words. They love a good buzzword in Congress to title a bill. Clarity Act is one of multiple different market structure bills that are in flight across different committees of Congress, because you've got committees that oversee the CFTC that are aligned with our agriculture committees, and then you've got groups that oversee, the SEC and their jurisdiction that are aligned with House Financial Services, Senate Banking. The overall uniting goal across each of these different bills is to pass market structure legislation that crafts defined lanes for digital assets. Right now, most of our rules for crypto have been created by agencies from experiences with market participants that have hit some sort of roadblock. We usually have created things out of issues that have happened as opposed to giving a full roadmap. So for market participants, you can think of it as the difference in driving on a dark road with only your instincts to guide you. You learn the rules from speeding tickets or flat tires. Clear rules and a clear market structure framework looks like bright stripes marking the lanes, posted speed limits, and a system that reduces not only uncertainty for how you should drive, but a little bit more confidence in how other cars are going to be operating as well. So while each of these bills differs in their focus and approach, the overall objective is to give clear definitions for what digital assets are securities or their commodities, and it makes clear which agency, SEC or CFTC, has oversight, and then promoting registration pathways that give what I call a more realistic model for exchanges, brokers, and custodians who are acting in this space to comply with the rules. Legislation is never going to eliminate volatility, but it does reduce that uncertainty premium that amplifies price swings for the long term. So excited to see something hopefully make its way towards the committees reconciling different drafts and coming up with one master bill that I hope we see signed into law later this year. But there is a lot of work ahead on those different pieces.
Okay, so we do get a lot of questions from viewers who are interested in investing in cryptocurrencies, or maybe they've already invested in crypto. But again, this idea of volatility is maybe stopping them from going farther or really giving them pause and trying to figure out what they want to do next. So we have a couple of questions that came in during registration. Miriam wants to know, how concerned should we be by crypto's volatility? Scott, obviously, like so many people, wants to know why it's so volatile. So I guess, Denise, how different or similar should people be thinking about crypto's volatility? And how would you answer Miriam's question about her level of concern?
Yeah, it's hard to get your arms around an asset class that has 75% declines, but yet remains in an uptrend. And I think the way to think about that is to think about equities overall, right? So back to that sort of equity comparison, and there is a relationship there. You see on average 8% annual returns in the stock market. This is the S&P 500 going back to 1962. But you never actually get those 8% returns. 75% of the time you get 20% returns, and then 25% of the time you have losses. So you have to ride through those losses or have that volatility to get the 8% returns. Said differently, the 8% returns aren't free. They come with a roller coaster ride. Bitcoin is 10 times that in equities. Back to sort of that relationship that you saw, the decline that you've seen of 30% is fairly normal for Bitcoin. We've seen it 6 times over the last 5 years. So that is a normal amount of volatility. So you can't really get around it. It is what it is. The way you think about it as an investor is, if the S&P 500, again, back to that comparison, has in any given year a 25% probability of loss, do I have a 1-year time horizon to lock up my money with that probability of loss? There's no way to get around the potential for loss in equities, just like there is no way to get around the potential for loss in crypto, especially given the volatility. But at a 5-year time horizon for the equity market, you have roughly a 3% chance of loss. So I think that there's a way to embrace the volatility and understand that volatility is the natural part of having high return.
Got a couple of follow-up questions for you, Denise, that came from people who I think almost anticipated your answers to that question, because maybe they're saying, all right, fine, I have to accept volatility. But, Mike's question, for example, seems to be looking forward, saying, okay, not just why the volatility, when does it stabilize? And Sandra wants to know how to reduce the risk of volatility. You mentioned time horizon already as a potential strategy for investors, but how would you answer those two questions?
Yeah, well, the irony is that it is changing. We are in the process of it changing, and yet it is still 10 times as volatile as the equity market. So, we've seen, I think, 6 drawdowns of 30% or more over the last 5 years. The prior 5 years than that, it was 12. So it was double that. So in some ways, the volatility is changing, but that arc changes very, very slowly. I think the way to think about it is that embrace that volatility, do your research in terms of the corollary of market adoption and sort of the corollaries to major economic variables, because that's going to be the risk or reward decision as it relates to the underlying asset. But yes, I think that's right, that even though it has changed dramatically, crypto is still a volatile space. That's likely not changing. The only way to mitigate it is to extend your time horizon.
Martha, anything you would add from the policy side?
Yeah, absolutely. Regulators don't look at volatility as a primary objective. Their mandate is around reducing fragility, making sure that the markets are fair and orderly and investors are protected. So think about things like run dynamics, hidden leverage, custody failures, market manipulation, other structural weaknesses that have implications for volatility. So again, it's indirectly getting at volatility, but not directly regulating in that space. So as I look at the questions that were flagged, getting this to fewer shocks that spill over from what I call one container or one environment in the crypto space into others, that's really the goal as we look ahead with some of those regulations.
And making crypto boring, I think, is sometimes what we say.
Yes, indeed.
I've got a question from Kramer that came in too, asking what we think will be the factors that might make the crypto market less volatile in the next 3 to 5 years, or at least that's probably how we could answer this question, because we really can't make any predictions per se. But I'd love if you could both weigh in on what factors you think or what events might occur that would induce or help volatility subside in the next 3 to 5 years. And Denise, we can start with you.
Yeah, listen, I'm the quant, so I'll throw out some numbers, and past performance is no guarantee of future performance. But let's talk a little bit more in depth about bending that curve. I threw out the stat of, you've seen 30% corrections over the last 5 years, and that's half as much that you saw during the prior 5. So in some ways, you can think about this volatility that is, again, 10 times the level of the S&P 500, not exactly being half, but certainly being disproportionately less than we saw in the prior 5 years. If we think as investors that adoption will increase, assets will increase, interest in that space will increase, and I'll leave Martha to talk about the regulatory that goes with that, one might expect that still to bend the curve. Now, the interesting part, back to the Netflix parallel that we were talking about, is if that curve bent in a consistent manner, again, it's a hypothesis, I have no idea from a prediction perspective, if you said that every 5 years you would decline by half, it would take you 20 years to be as volatile as the S&P 500. Meaning, if you're expecting crypto or Bitcoin to get boring, it's probably not going to happen statistically anytime soon.
All right, Martha, how about you?
I love that. And, I love the Netflix analogy, Denise, for bringing in regulatory things with open internet and what that did with the debates that were happening. There were regulatory hooks that did, I think, ultimately wind up smoothing some things out in the long term. From my lens and the policy sphere, I think that volatility over the next few years is going to reflect whether we wind up with a coherent U.S. perimeter. So some of the top things that I'm looking at are really the outcomes of the market structure legislation, which then has the effect of reducing that uncertainty premium and increasing participation by sophisticated and regulated intermediaries. And what that does is deepens the liquidity pool. And you're no strangers to that are listening to this. And Denise is certainly a pro there. That certainly has the effect of smoothing out some of those rough spots. Another area that we're closely tracking is the implementation of the Genius Act and the emergence of more regulated players as issuers, custodians, and infrastructure builders. Think more traditional financial players. I feel like every week we've got a new announcement of someone else building something, applying for something else. That's going to be really big for the space. The wild card here for me is cross-border fragmentation and what happens if our rules diverge instead of converge with what other countries are doing. So what's that impact if you have liquidity consolidation across the board, or if you wind up with fragmentation? That's going to really change activity dynamics, which may wind up with really interesting and potentially highly volatile swings that happen that play off of different jurisdictions having very different rules.
Yeah. All right, we are about to head to our live Q&A section, but before we do that, I would like it if each of you could just give the audience your top 2 or 3 takeaways. This is a long live stream, lots of content covered, but what are the 2 or 3 things you think people watching now should definitely remember about crypto's price changes? And Denise,
Yeah,
we'll start with you. Sorry.
yeah, I'm happy to go first as the quant. Yeah, I think that, when you look at the numbers, there's a lot of people that talk about what Bitcoin or crypto might be. Eventually, I'll be the one who talks about what it is. And that's, again, the closest corollary is not to the dollar or bonds or gold. It is to the equity market. So to me, Bitcoin specifically looks like a risk-on asset with 10 times the volatility of the S&P 500. That's important takeaway, at least from my math. The second important takeaway is the one we sort of talked about over and over again, is the way to mitigate the volatility is to extend your time horizon. That allows you to ride through the cycles.
Got it. And Martha.
Yes. So I'd say two things. One, crypto doesn't move directly on regulation. Markets do, though, price in policy changes over the long term. So keep that in mind. It's not a direct correlation, but it certainly has an impact. And the second is that policy is never going to eliminate volatility. What it is going to do is reduce tail risk and smooth out the extremes by making the markets less fragile and containing those spillovers so it stays on aisle 3 for the spillover cleanup and doesn't take over the entire marketplace.
Super important. All right, thank you for that. Let's head to some live Q&A. We're going to start this off with another live poll, turning to our live audience. We try to answer as many live questions as we can. Inevitably, we can't get to every single one. So we thought what we would do with the live poll to kick off live Q&A is to grab 4 questions that have come in from viewers and let the live audience pick one to decide how we start off this session. So if you're watching live on Fidelity's website, head over to the live poll tab and then vote for either A, B, C, or D if you want us to talk about the connection between Bitcoin and altcoins, talk a little bit more about crypto regulations in 2026, what historical data can tell us about trends in Bitcoin's price, and then finally, crypto versus trends we see in the broader stock market. And with that, I will turn to Kelly to see if there's a winner on that poll.
Awesome. Yes, Jim, we do have a winner. So it looks like option B, will potential 2026 crypto regulations drive adoption and price, has won close to 40%.
Ooh,
all right, Martha, I know that's a tricky one. How would you answer that?
Yeah, so I would say that the market is going to care about the details, not just whether we get rules, but what those rules say and the level of clarity that they provide. I think that's the most overused term right now, especially given that there's the Clarity Act in flight. But whether or not it is super clear how we know who's permitted to play, who's supervising, and then importantly, how quickly those rules actually come into effect. There is a lot that is on the agenda, particularly for the SEC. And so I certainly think that it can have big implications for adoption. We've just got to see exactly what those rules entail.
Excellent. All right. And Kelly, let's grab as many live questions as we possibly can. Some of them, of course, will be echoes of things we've talked about already. Others might be net new, but I'll turn it over to you.
Awesome. Yes, tons of questions. So thank you all so much for so many great questions. We are going to do our best to answer as many as possible. Let's start with one of the most upvoted questions in the chat right now. So we have this question from Scott. Will diversifying among cryptos reduce risk, like with traditional diversification in stocks or bonds?
Oh, so that's interesting. Denise, what's your perspective there, right? Because you could put together a very vibrant portfolio trying to be in different sectors and all these different industries, different size capitalizations. Can you do the same thing with crypto, do you think?
You don't see diversification trends just yet. Not any persistent negative correlations on any long-term level. We can sort of point at places where Bitcoin and Ethereum diverged, but at the end of the day, when you look at any meaningful trend, let's call it 6 months, 1 year, 18 months, those correlations are very close to 1. So from that perspective, diversification is much, much harder in the crypto space.
Got it. Okay, Kelly?
Great. This other question we actually had last episode, but we're getting similar questions in the chat right now. So how might recent geopolitical events affect crypto prices?
Yeah, right. Not a surprise that question comes in with everything happening on the global stage right now. Martha, let me start with you. What's your sense of how those macroeconomic factors?
Yeah, I mean, I think certainly as you look at uncertainty about underlying fiat currencies, you wind up seeing sometimes a flight to crypto, but it remains to be seen what the ultimate implications are, particularly as you look at international remittances, which is one of the major areas in which I think we see interest from our side of the house in the policy sphere.
And Denise, I'd love to have you weigh in too, sort of global instability and what it does to investors' plans or thinking.
It's really tough to correlate it to market returns over any
Yeah.
meaningful period. I mean, even in World War II, from the beginning of World War II to the absolute end of World War II, the S&P returned 6 percentage points a year on a CAGR basis. So again, I think using geopolitical risk to buy or sell can sometimes lead you astray because it's not the critical driver to the market. Things like earnings, profitability, GDP growth, inflation are.
Got it. Okay, Kelly?
Awesome. Yeah, so another question we have is any short-term or long-term data that we can look at to evaluate what Bitcoin's performance might look like?
Smells a little bit like they're asking for a prediction, which we will veer away from, knowing that past performance is no indicator of what's to come. But Denise, how would you answer that?
Yeah, the closest pattern I see in the data is sort of twofold. It's interest rates and it's growth. So there is a relationship stronger to Bitcoin than it is to the equity market. Of the lower interest rates are, the more likely Bitcoin is to advance in the future. And it's very monotonic and very linear. Obviously, it's not 100% odds, but to the extent each click you see interest rates being lower, I think that's got to perk up your ears as a Bitcoin investor or a crypto investor to be more interested in the asset class, given the close correlation over time. The second part is you might be tempted to say, well, if interest rates are going down, that's usually a function of a bad economy, or it means that the labor market is deteriorating, or anything else. Interestingly enough, Bitcoin does better when growth is stronger. So the higher EPS is, I'm using the broader profitability of the S&P 500, the more likely it is to rise when interest rates are lower. And to me, when I look at the patterns, that's the exact setup we actually have going into 2026.
That strikes me as counterintuitive, should it?
Always, right?
Funny. All
Market
right.
probabilities are more often than not counterintuitive. And that's why I always say, like, it's the struggle with what you know for sure that just isn't true versus just not knowing. That's the problem.
Exactly. All right. Kelly, are there more?
Yes, there are. So we'll keep going here. So
Yeah.
another one, how do we value crypto? Big question that we get quite a lot. And Dan asks, is technical analysis the only method, or are there metrics or correlations that we can use?
Denise, I'll turn back to you because I know that well, obviously everyone's relatively new to crypto, but you've got your vibrant tool basket that you use to look at sectors in particular. How do you look at crypto as well?
Yeah, back to it being an emerging class, I think that there is a relationship not to any underlying, asset or earnings. Obviously, isn't the case for Bitcoin, but it is relative to adoption. I think that's the way you have to think about it. We used to evaluate all the time the adoption curve of new technology stocks, and that 30% point when you had 30% adoption from the ultimate penetratable area of the overall economy, that was sort of the sweet spot for performance. So you can measure it a bunch of different ways, but that's the relationship I think that you should be looking at as an investor in any kind of emerging asset classes. It is hard to get your arms around what the ultimate quote value is, but it is very closely related to adoption rates.
And one thing we always like to point out too is that not all cryptocurrencies are created equal by any stretch of the imagination. So you may well do your research and determine that a given coin or token has no value, right? It could very well be a scam. And that's why we are so deliberate about education and about moving slowly and about asking the right questions and getting answers from people you trust, because not all cryptocurrencies have value. But Martha, I'd love your perspective on that question too. I think some people certainly feel like regulation and policies around cryptocurrencies might induce more people to have confidence in the value of worthwhile coins and tokens. Is that fair?
Yeah. So, there's the phrase that we don't regulate in the United States assets based on the merits of if it's a good or a bad investment. That's not something where regulators put their thumb on the scale. Instead, we have a longstanding history in this country of regulating the disclosure about those assets and ensuring that those who are transacting have the benefit of transparency and equivalent information. And so I do think as we look ahead, we're looking at, what is likely to be right-sized disclosure regulations that factor in and would standardize the types of disclosures that you get, particularly for digital assets that fall within the securities framework, think things that focus in on technology risks, on, operational controls, on protocol upgrades, and variables on kind of utility of those tokens and what can be built within the system that is going to give something, I would say it's a yes and for what you can use to evaluate beyond, as Denise was flagging, adoption rates, giving you more standardized information. Exactly what that entails remains to be seen, but we certainly expect those disclosures to have a very technology heavy bent to them.
Excellent. Okay, Kelly, back to you.
Great. We have a question here on how can something like the upcoming Fed election or other elections impact crypto markets? Similar topic.
Wow, that right. That feels like I'm thinking that through. There are so many knock-ons from any one thing that could happen. But Denise, how would you answer that one?
Well, I'll go back to the data in terms of lower interest rates. That
Okay.
is where you have seen the pattern. So to the extent, and I think it's less indicative of the Fed as to ultimately what the right answer might be on inflation. To the extent, and this is sort of what I see in the data, that we continue to see inflation decelerate, especially as we lap the tariffs, that allows the Federal Reserve, potentially whoever is in charge, to continue to renormalize rates, not because they have to, right? Not because the labor market is weakening, but because they can, because inflation is lower. And that has usually been positive, not negative, for Bitcoin specifically. So in some ways, that's, I'm answering the Fed question, not necessarily who is in charge, because I think at the end of the day, regardless of who is in charge, the Federal Reserve as a cohesive unit has been fairly data dependent. So to the extent that the data continues to come in, like we saw this morning, that inflation isn't as high as they thought it was, it allows for the Federal Reserve to continue to renormalize rates, which is usually good for rate sensitive assets like Bitcoin.
Martha, any context you would add there, just from having a finger on the pulse of what's happening in DC?
Denise covered it really well. My crystal ball doesn't predict what's going to happen with the Fed, unfortunately, but it certainly, I think, will have implications for their areas of policy focus and research focus if there are any leadership changes.
Got it. All right, Kelly.
Great. Another question here, actually a twofold question. So are some cryptos less volatile than others? I know we've already talked a bit about volatility here. And then with that, what are a few indicators that we can look for when selecting a crypto asset for investments?
All right, Denise, globally, crypto volatility.
Yeah, and I mean, you run the gamut in terms of different coins and different volatilities. The one thing I'll caution in terms of, when we look at the asset class or when anybody looks at the asset class is there's survivor bias adjustments going on, meaning that there are some coins that are already sort of extinct or out of service. So when you compare it now and you say, okay, this coin is less volatile than either Bitcoin, the OG, or less volatile than the other coins that we can evaluate, don't forget about those asset classes that essentially went away. So when we study the equity market, we are always very conscious of having that survivor bias adjustment. And you have all of those companies in our data series that eventually went bankrupt. That if you just took the companies today, you'd get a very different data stream. So when you think about volatility, are there some less volatile than others? The answer is yes, but I think ultimately, you need to focus from an investment perspective of the ultimate winners, which again gets back to sort of the corollary of adoption. It doesn't necessarily mean that a lower volatile coin is potentially a better one. It might actually just be lower volatility because it is sort of about to be extinct. So there's always that to understand as well.
Really, really good point to make. Thank you for that. And I'll just add to that, as a reminder, the barrier to entry to spin up a new coin is so low, and it is so easy for someone to introduce a coin and maybe get a social media influencer or two, or for a celebrity to do it and introduce a meme coin. So the longevity that Denise was just speaking to is one of many factors to keep in mind, but also it's worth calling out. Again, the barrier to entry is so low. And so you might certainly see volatility with a newer coin that people are trying to wrap their heads around and trying to figure out what it's all about. Kelly?
Great. So another question here, how should I consider crypto for a long-term investment with some of this volatility that we've talked about? And I am about to retire, so how do I think about that?
Okay, so kind of an echo, Denise, of what you were talking about earlier, where your take on volatility should have at least a little bit, if not more than a little bit, to do with your personal time horizon.
Yes, absolutely. I mean, and it's very personal, right? And personal in terms of your ability to withstand sort of downside momentum, which is again personal for each individual investor. We talked about the equity market, which is, in some ways from an S&P 500 perspective, you would like to have a 3 to 5 year time horizon to lower your probability of loss, if that's what you're worried about. And that has to be sort of even more for something like crypto or Bitcoin as an asset class.
Thank you all, Kelly, Martha, and Denise, for taking time out of your day to be with us. And certainly thanks to everybody who spent time asking questions and waiting for their question to be answered. I feel like we got to a lot of them. I know we answered a lot more in the chat as well. So thank you for your patience. And again, thank you for spending time with us today. We'd love it if you could register for our next live stream. We'll put up that URL again. It's on taxes, so there's no shortage of questions there for sure. Ask us questions when you register, or join us live and ask us live in the chat. We are always thankful for your participation, and we hope to see you again very soon.